All right, welcome to our fourth quarter market commentary. I'm Ray Lucia Jr. I'm here with our Chief Investment Officer, Mark Scalzo. And before we get started, wow, as we recap 2017, what a heck of a year we had. It was very positive for everybody on a number of measures, and we're so excited to recap what happened last year. And then we'll get into a little bit about what's going on recently in the markets so far this year in 2018. So welcome Mark here to the desk. Mark, how we doing?
Hi, Ray. It's been a good year. 2017 was very good across a number of measures, and looking forward to a very interesting so far 2018.
And interesting is maybe an understatement. But let's first talk about what happened last year. We're going to recap a few things like the markets. We're going to talk a little bit about monetary and fiscal policy and the economy. And then lastly, we'd like to finish up with what everyone wants to know is how Mark and his team are positioning our portfolios today into 2018 and beyond. So, Mark, let's just get into the markets. I know your team goes all the way into the details on everything, but likes to boil things back to real simple for people to understand what's going on with stocks, what happened with stocks last year, what happened with fixed income or bonds, and then, of course, alternative asset classes.
Yeah, it was... really across almost all equity markets, it was a really, really positive year. I think returns generally in the sort of 20 to 25% range by geography. U.S. was kind of at the low end of the spectrum, and world markets, emerging markets, were kind of at the higher end of the spectrum in terms of returns. But overall, anytime we're talking about double-digit returns and starting with a 2 in most markets, that's a pretty good year for the equity markets, almost more than we can sort of expect on a consistent basis going forward.
And in our financial planning, we never even try to look at projecting returns, even in the double digits for our equity portfolio.
Sure.
So last year exceeded expectations without a doubt. So Mark, but what about the fixed income markets? Because we're talking about rising interest rates and other things. The equity markets were great across. They had what they call it, the synchronized
global recovery. Well, that's the economy. You're moving ahead a little.
I know. I want to move ahead, but it seems like almost all asset classes went up last year, including fixed income, which is usually there's a yin and a yang.
Well, with equities, as I said, international outperformed U.S. Growth outperformed value, and we saw more of this. We continue to see this sector rotation going on, where instead of the market correcting, which is kind of what everyone was expecting. We've gone through a very long period without the market kind of adjusting in the short run, which it always seems to. What happened, I guess, more interestingly, is that different sectors went into more of a correction or bear market. So, retailing, we've talked about that. Very challenging at times, although it kind of recovered towards the end of the year because it had overcorrected, if you will. So what we saw is kind of movement around the market, and overall the market kind of sustained its upward momentum in the equity side. On the fixed income side, a pretty decent year, frankly. I think better than we were expecting. Really expected rates to start to go up in a more meaningful way. Certainly, the Fed has been trying to move rates higher. We saw a series of increases in the Fed funds rate. We've seen a liquidation on a small scale of the beginnings of a liquidation of the Fed's balance sheet. So it ballooned up to $4.5+ trillion. The Fed is trying to decrease that over time, which is going to take some time.
It'll be interesting to see how the markets digest that change
right.
as well.
So in the U.S., we're removing liquidity for the system. Okay. So after this multi-year, unprecedented experiment about providing liquidity in the bond market and to the market in general, we are now removing that. So we'll see how that goes, and it's one of the reasons why, if you remember the third quarter, we said we expected volatility to increase here because we're, that kind of unwinding of liquidity is not going to be a completely smooth ride.
Right, there's going to be a domino effect across the markets as that begins to unwind?
Well, I think I don't know if I would think of it as a domino effect, Ray, but really, we're in uncharted territory, and that when the market is can't sort of easily predict the future, that uncertainty creates volatility. So we would expect more volatility. We expected it in the third quarter. We saw a little bit of an uptick in the fourth quarter, but much more, which again we'll talk about, much more so far in 2018.
But volatility is good for the traders who've been striking out since vol was basically in the 9 to 11 range.
I would say it's good for, theoretically it should be good for traders. It should be good for active managers, because your decisions that you're making in terms of how to tilt the portfolio or how to adjust the portfolio should be adding value over time. And that includes, the alternative space, which we haven't touched on. I would say pretty disappointing year for alternatives when sort of the best asset classes within alternatives were up, 3 or 4 or 5%. Against the backdrop of equity markets being up, 20, 21, 22, 25%.
Right.
Continues to be kind of discouraging to have an allocation to alternatives, but we think well worth it in the long run. Remember, alternatives behave differently. That reduces volatility. But in a year
but when the market
like this,
keeps going straight up, Mark,
doesn't really feel rewarding.
I mean, we always hear, why should we be invested in alternatives anyway? Right? When the market just goes up.
If you have been an investor who's allocated to alternatives, it's been pretty unrewarding in terms of return for the last 6, 7, 8 years.
Right.
It has reduced your overall risk. It also has reduced your overall returns in the short run. But we think it's still prudent. It makes sense to have an alternative allocation in your portfolio.
Which I agree, and I don't know who said this, but if everything in your portfolio goes up, you're probably not diversified.
That's right.
Right.
That's right. If everything's going up at the same time, probably not a good thing in the long run.
So, Mark, let's move on to fiscal and monetary policy and how you and your team are looking at that and how it impacts the world and then obviously ultimately our clients' portfolios.
Well, what an interesting year. You had the Fed. As I said, sort of changing its stance, right? Now tightening monetary policy, taking liquidity out of the system. And remarkably, really until the end of the year, you really haven't seen rates move up. So the market has sort of, in a sense, ignored what the Fed is doing to tighten monetary policy in the U.S. And I think for a long time in 2017, the world was wondering what the bond market saw. The bond market's supposed to be the smartest market, quote unquote. Bond investors are supposed to be the smartest investors. And so what is everyone else missing with the stock market doing so well? The bond market must be telling us something, having yields so low, about the economy in general, meaning it isn't as good as we think it is. But as it turns out, the question I think is more, why were rates there to begin with? We had rates low all over the world. At times we had German bunds having negative yields. So basically, you were paying them to hold your money, essentially. That's the effect of that. So why were yields so low around the world? I mean, I think it's an interesting question with the economy doing so well. And the more data we've gotten over the course of 2018, the more it's demonstrated that the economy is really firing on all cylinders globally. This global synchronized recovery that we haven't seen really over the last 8 years. So, what we've seen now towards the end of the year is rates actually starting to move up, yields starting to move up along with it in the bond market. And as yields go up on the bond market, remember there's an inverse relationship between rising yields and bond prices, which go down. We are looking at a situation where if yields continue to go up, we could see the bond allocation actually losing value, which would be a real change from the last 30 years when we saw appreciation. You could expect both income from bond portfolios and appreciation.
So when you look at that, then you're looking at more safer credits. Then removing maybe high yield exposure in that case. I mean, what are you and the team looking at? Because I mean, you just can't eliminate bonds from your portfolios altogether.
No, of course not. And it's prudent to have that allocation. There's ways to manage your interest rate risk. I mean, as I've said before, you can reduce your exposure to higher yield securities. You could, we've actually got sort of interest rate hedge, different strategies that we use in terms of the allocations in the portfolios. But it's not just about interest rates. It is about credit quality, right?
Right.
There are other risks to owning bonds that go beyond just what interest rates do. So you have to pay attention to all of those things when you're constructing portfolios. Right now we have a pretty, I think, maybe on the conservative side of what we expect with interest rates, but not a dramatic where we're taking durations to, to zero or something like that, because that would imply that we're being extremely conservative and be very difficult to generate income in that environment or with that allocation. We're kind of have I would say, conservative to sort of midpoint view of where interest rates are and how quickly they should go up from here.
So, and then we also saw last year, Mark, the president signed the new tax law.
And I think that was unexpected when it actually happened. As the year went on, there was increasing skepticism that anything positive could happen in Washington, that, early optimism with the election of Trump and all the things he was talking about doing for businesses, kind of faded as the year went. And
right, and they failed on health care.
Yeah,
and it was a lot of uncertainty into whether the Republicans could actually get anything done.
Right. So, Congress in general. So as we got even to November, the probability of getting tax reform done in 2017 was pretty low. In fact, even in the beginning of 2018, it was pretty low. And then they actually got it done, and then the market responded to that in a really, really positive way. In the last couple weeks of the year, we saw stocks kind of take off, and it was because, if you think about it, if the day before you had an assumption about all these companies and the tax rate they were paying and the earnings they were going to get, and then you lower that and their earnings go up
because they're paying less in taxes,
and you kind of have to reprice that.
Right.
But there's a couple other positives, I think, real positives to the tax plan from businesses' standpoint. We can argue whether or not it was a great thing for the average American in terms of their paycheck.
Yeah, I don't want to talk about me and the state of California.
Sure, yeah.
Anything,
but and the state of California has its own plans, but that's another story. There were two other aspects, I think, that were really, really positive. One, the immediate expensing of capital expenditures, for a period of time, which should jumpstart investment by businesses, which has kind of been stagnant for a long time. And then two, the repatriation of cash held overseas. That's required. There's going to be I think it's 11%, something like that, 12% tax hit to moving that money back. But since then, companies like Apple and others have said that they're going to repatriate all this cash and invest it in the U.S. So that should be very positive, and the markets responded, accordingly in a very positive way.
So, in the jobs and then the $1,000 bonuses, it just seems there's tons of optimism out there. But, with optimism comes some pessimism as well. and volatility. Let's talk a little bit about volatility, because we've seen it recently, the past week or so. But last year, not much volatility at all in the market. Everything just seemed to just go up.
And we've talked about it in our commentaries. This has been a almost unprecedented time of low volatility in the markets, and generally what happens over time, and this is again what we started to write about last quarter, is that it's like I compare it to what happens with a tectonic plate. The pressure builds up over time, then eventually, it seems quiet, right?
Right.
As this pressure is building, and then eventually you have an earthquake.
Right.
And I think we've had some tremors early on in 2018. And you really can't expect volatility to be that low indefinitely, and so we don't. And it's interesting, as we've seen some volatility in the market so far this year. We really didn't see any in January. It's really been in February that we've seen it.
Right.
It feels worse because volatility has been so low for so long. So it actually feels worse than it is. And not to say that it isn't bad when the market goes down and we have volatile times, but I think we're even more sensitive to it because we've been through this period where we never go down very much for very long.
Right.
And so therefore that expectation is, creates you become a little desensitized, and then when it happens, you become a little shocked.
And now, recently, we're seeing 100-point changes on the Dow and 1,000-point swings.
Right.
1,000-point swings within a day. I mean, we were in my office just last week. We couldn't even finish a sentence, and the market would change 0.5%.
Yeah, and I think there's a number of things happening as we got into the new year. That optimism about the economy. In fact, there was one of the Federal Reserve banks in Atlanta put out their forecast. They thought first quarter GDP was going to be 5.4%. Now, supposedly there's some issues with that number, and obviously it seems very optimistic. But think about the concept of the potential of being somewhere near 5%. In terms of GDP growth for a quarter. I mean, that we have not seen that in a very long time. So that optimism really carried over, the end of the year optimism carried over into January,
right.
And we saw literally almost every day be an up day for the market. And again, what started to then happen, you said sort of, all of a sudden good news became bad news. And the bad news was, well, if the economy is growing this quickly, if wages are starting to go up, then all of a sudden now we have to worry about inflation. And if we have to worry about inflation, that means the Fed's going to go quicker than we think. That means rates are going higher, and that means that could eventually be a governor on the overall growth in the economy. And so it's really odd. In the space of a couple of weeks, our concern with the market became inflation. And we haven't seen that in a very long time.
And I know what investors are most worried about is this the beginning of the end, right? Is there a recession around the corner? I know you and the team, you're looking at all sorts of economic indicators. You follow the economic growth cycle that we talk about in the market commentary every quarter.
Right.
So has anything changed with the probability of a recession?
Well, we look at the probability of recession is generally almost in every case tied to these forward-looking indicators and how they move. Obviously, we paid attention to what actually happens versus what is projected to happen. But those recessions correlate very strongly with bear markets, essentially.
Right.
It's very hard for you to have a bear market unless you have some technical issues outside of a recessionary economic environment. And right now, in fact, since the end of the year, the economic indicators have gotten stronger. Now, maybe if you had a period of persistent market volatility, that could change things like sentiment and consumer confidence, and it could create sort of this self-fulfilling prophecy at some point. But we're very far away from that at this point. We're talking about, at most, I think we're at a max 10% correction in the S&P so far in February. And that's not going to impact economic indicators in a way that's going to change the trajectory of the economy in the short run. It would have to be much more sustained and much more meaningful for that to affect the economy. So when we're looking at that, and we're talking globally now, we're talking about firing on all cylinders globally, economically. The recession probabilities are extremely low, a couple percent. And in that kind of world, you generally don't see a dramatic downturn in markets that's sustained.
So that's really good, Mark, because the way I interpret what you just said is recession probabilities are low, and most of us are long-term investors, so there's no real need to get caught up in the short-term movements of the market when we have a long-term perspective. So let's segue now over into the portfolios, and the series of portfolios that you and your team manage on an ongoing basis. Break it down into 3 portfolios: an income portfolio and a series of ETFs and mutual funds there, a balanced portfolio, and a growth portfolio. The income portfolio, I understand the way you guys look at that is it's really based on interest rate sensitivity. And the balanced portfolio, you're looking at how much fixed income versus stocks you should own. You're going to own some bonds like we talked about earlier. And then the last one is all about growth equities. How much should we own in U.S. stocks versus non-U.S. or international stocks? So how are you looking at these portfolios today, and how are they positioned?
Well, remember, when we go back to the economy, we have an economic growth model that tells us, gives us an indication of whether the economy is accelerating or decelerating. And that gives us because of how the market has reacted, the bond market, equity market, alternatives has reacted historically during those periods of times. We know sort of how to tilt the portfolio in the short run, towards rising rates or away from them, or how to sort of adjust things in the short run, how to fine-tune things, if you will. And that we do tactically. So you mentioned that we might look at what's happening in the interest rate environment, deciding to take less interest rate risk or more interest rate risk. That starts from a portfolio, by the way, that's diversified across different income asset classes. Okay, so that's from the beginning. And then you decide, well, do I want a little bit more of this, a little bit more duration? Do I want things that are a little bit longer in maturity, for instance? A little bit more duration? Am I not as concerned with interest rates? Or am I concerned that they might go up more quickly, and therefore I have to own things that are a little bit more protective when interest rates are rising? So it's that kind of shift, let's say, in the income bucket. And right now, generally, we'd be down the middle of the road. Our target duration for our sort of standard portfolio would be around a 3. We might be getting a little bit, find ways to be a little bit more conservative as rates rise a little bit, and maybe they might rise a little faster than everyone is expecting. So we might, we're kind of tweaking things on the margin, if you will, in those portfolios, but pretty much staying the course. We don't expect interest rates to suddenly go up dramatically, even from here. And we probably expect them to moderate a little bit from here before they continue their rise in a more measured way from here. So we would be kind of, I guess, on the conservative side of middle of the road, if that's a good way to describe it.
Conservative side of middle of the road. You know what I do like about this structure is there's a process.
Yes.
Right. You have a process that
right.
determines what phase you're in the economic growth cycle, and that's the beginning of the process for then determining whether you should be in the more conservative side of the middle of the road.
That informs our judgment. We're certainly not going with our feelings about how, what's happening in the market and how that might impact our portfolios. We're going to rely on data, and we're going to rely on how the market has performed over time as a way of informing our judgments. But we keep a close watch on it, obviously. And then on the balance side...
Yeah, so what's the process tell us today about our balanced portfolios?
So there we're making decisions, we're making a lot of decisions, but in a tactical sense, in the short run, we're making decisions based on the economic growth cycle of whether we should be overweight equities, meaning away from a 50-50 portfolio. We should be more in equities or less in equities. And right now we're going to be tilted towards more in equities. Remember that even the equity exposure in the balanced portfolios are lower volatility. The growth models are going to be much more exposed to more growth-oriented equities. We want the performance to come from a momentum that comes, starts with earnings and starts with how companies are doing. So when we look at that, one of the things we consider is how much international exposure do we have in those portfolios. And right now, again, we're sort of at the middle of the road with roughly a 35% allocation to non-U.S. stocks. It would suggest in this part of the economic growth cycle that you want to be overweight U.S. equities at the moment. Although there still are some attractive opportunities internationally, and we might see that changing in the future.
Very well. So quick recap, middle of the road for income portfolios, tilted towards equities in our balanced portfolios, and then kind of middle of the road, which is maybe a 65-35 allocation to U.S. and non-U.S. stocks in the growth portfolios today.
Right.
Very, very cool. So that's just about does it for our fourth quarter commentary here at Lucia Capital Group. And I want to thank everybody for spending time with us on the show. We look forward to doing this again next quarter. And thanks again, Mark Scalzo, Chief Investment Officer, for joining us. And we'll see you next time.